Banks. Everyone knows what banks are. But why do most of us have multiple savings accounts that promise meager returns instead of investing? Well, in actual fact, your savings is losing value against the inflation. When compounded every year, do you realize the permanent loss that you are making if you keep a savings account with the bank? It's important to note that not all banks engage in practices that may be perceived as unfair or harmful to their customers. Besides the savings issue highlighted earlier, there are some common ways in which banks may try to make money at the expense of their customers. Here are a few examples. 1. Charging high fees. Some banks charge fees for many things. These fees can add up to a substantial amount. Banks may charge a variety of fees to their customers. Some common fees that banks charge include 1a. Monthly maintenance fees. Some banks charge a fee for simply having an account with them. These fees can range from a few dollars to several $100s per month, depending on the type of account and the bank's policies. 1bit. ATM fees. Many banks charge a fee for using an ATM that is not part of their network. These fees can be as high as $5 or more per transaction. 1c. Overdraft fees. If you make a purchase or withdraw money from an ATM that exceeds the balance in your account, you may be charged an overdraft fee. These fees can be as high as $35 or more per transaction. 1d. Wire transfer fees. Some banks charge a fee for sending or receiving a wire transfer, which is a fast and secure way to transfer money between banks. These fees can be several dollars to several $100s, depending on the amount being transferred and the bank's policies. 1e. Credit card fees. Some credit cards come with annual fees, balance transfer fees, and cash advance fees. These fees can add up and can significantly increase the cost of using a credit card. 3. Offering high-interest loans. Some banks may offer loans with very high interest rates, especially to people who may have difficulty obtaining credit elsewhere. These loans can be difficult to pay off and may end up costing the borrower much more than they anticipated. Why do banks offer high-interest loans? Banks may offer high-interest loans for a variety of reasons. One reason is that the borrower may be considered a higher risk due to a poor credit score or a lack of collateral. In these cases, the bank may charge a higher interest rate in order to compensate for the increased risk. Another reason that banks may offer high-interest loans is to make a profit. Higher interest rates mean that the borrower will pay more in interest over the life of the loan, which can be a lucrative source of income for the bank. It's important for borrowers to be aware of the interest rate on any loan they are considering and to shop around to ensure that they are getting the best deal possible. It may be worth considering alternative forms of financing, such as a credit union or an online lender, if the interest rates offered by banks are too high. What happens if you do not pay bank loans? If you do not pay a bank loan, it can have serious consequences. The most immediate consequence is that you will likely incur late fees, which can add to the total amount you owe. Your credit score may also be negatively affected if you miss loan payments, which can make it more difficult and more expensive to borrow money in the future. If you continue to miss payments and fail to pay back the loan, the bank may eventually take legal action to recover the money you owe. This could involve garnishing your wages or taking money from your bank account. In extreme cases, the bank may even file a lawsuit against you and seek a judgment that allows them to seize your assets in order to pay off the loan. It's important to try to avoid falling behind on loan payments if at all possible. If you are having difficulty making your payments, it's a good idea to contact the bank and try to work out a plan to get back on track. In some cases, the bank may be willing to modify the terms of the loan to make it more manageable for you to pay back. 3. Selling financial products with high fees. Banks may try to sell customers financial products, such as credit cards or investment products, that come with high fees. These fees can eat into the returns that customers earn on their investments or increase the amount of interest they pay on credit card balances. Why are bank products bad? It's not accurate to say that all bank products are bad. In fact, many banks offer a wide range of financial products and services that can be very helpful and convenient for customers. However, it's important for consumers to be aware of the potential drawbacks of certain financial products and to carefully consider whether they are a good fit for their needs. Here are a few potential drawbacks of some bank products. 3. High fees. Some bank products, such as credit cards and investment products, come with high fees that can eat into the returns earned by the customer or increase the cost of borrowing. 3 bits. Complex terms. Some financial products, such as mortgage loans and credit card agreements, may have complex terms and conditions that are difficult for the average consumer to understand. This can make it hard for consumers to know exactly what they are signing up for and what the potential risks and costs are. 3C. Misleading marketing. Some banks may use misleading marketing techniques to sell financial products, such as exaggerating the potential returns or downplaying the risks. This can lead consumers to make decisions that are not in their best interests. 4. Manipulating exchange rates. Some banks have been accused of manipulating the foreign exchange market in order to make a profit at the expense of their customers. How are banks manipulating exchange rates? There are several ways in which banks may attempt to manipulate foreign exchange rates. One way is through front running. This is when a bank trades ahead of its clients, using information about its clients' pending trades to make its own trades at a more favorable exchange rate. This allows the bank to profit at the expense of its clients. Another way that banks may manipulate foreign exchange rates is by colluding with other banks to coordinate their trading activities. This can involve agreeing to buy or sell a certain currency at a specific time in order to move the exchange rate in a desired direction. There have been several instances of banks being accused of manipulating foreign exchange rates. In 2013, several banks, including Citigroup, JPMorgan Chase, and Barclays, were fined billions of dollars for their roles in manipulating the foreign exchange market. However, it's important to note that not all banks engage in this type of behavior. It's always a good idea for consumers to do their due diligence and carefully research any financial product they are considering before making a decision. This can help ensure that they are making an informed choice that is right for their needs. Be smart. Take your time before making important financial decisions in your life.